Hi, I'm Patu from freefincal. Today, let's talk about why most people will not be successful index investors. I'll limit my comments to an Indian perspective and talk about why this is the case. Um, Most mutual fund investors are heavily influenced by past performance and not just consistent long-term past performance. They are heavily influenced by recent past performance, last couple of years, what the fund did in the last 6 months, what it has been doing in the last 3 years, and so on. And that is the dominant selection factor when they pick mutual funds, and uh, that simply has to go if they want to be index investors, and therefore that's a big factor that's going to prevent them from becoming index investors. The other problem is after they choose the fund, they start comparing the fund's performance with other funds. Whether they're active or passive does not matter. Peer comparison is a dominant review factor. They're heavily influenced by star ratings, which is peer comparison. And uh, the if you I have already shown that the inflows in Nifty Next 50 index fund started increasing only after they saw the recent past performance, and when they recognized that the recent past performance has fallen down significantly, the outflows started, or at least the AUM did not increase as much. And again, one of the biggest problems of why index funds are being talked about recently is because of the domination of a few stocks in the Sensex and the Nifty, and that's the reason why people start talking about why large cap funds have struggled to beat index funds and so on. Although quantitatively that is not true, I have shown that also. That's a different matter. I'm talking about what other people are doing, and if the situation normalizes, and once all the stocks in the Sensex reflect what is really happening in the rest of the market, then the situation can change. The interest in index funds, already it is low, I think, in my opinion, will go down. But a peer comparison simply cannot be an attribute the index investor should have. Fear of missing out is again a big disruptive factor in portfolio management. If you tell people all you need is a Nifty index fund, then they will ask, "What about the Nifty Next 50?" Okay, add a Nifty Next 50. Then they will, then am I not missing out on mid caps? Then you say, okay, add some mid caps. Then am I not missing out on small caps? It never ends. They think that they are missing out something and they feel that they have to add. And if you say invest in the Nifty 500 index and say, oh, Nifty 500 does not have enough of mid cap and small cap exposure, na? That's I mean, this fear of missing out is cannot. I mean, it just cannot help at all in general, and especially for index investing, it just doesn't work. Confusion is hard to overcome. My God, pick a damn Nifty index fund, man. Stop. Oh, which has got the lowest in the expense ratio, which has got the lowest tracking error. I mean, people keep asking. It's very easy to find out the tracking error, find out the expense ratio, do a comparison, but then they must understand that what is low today in terms of tracking error, what is low today in terms of expense ratio, may not be the case, because these AMC fellows are changing expense ratios every month. So after you start investing, they will start increasing the expense rate. That just happened yesterday or day before to ICICI Nifty Next 50, I think, or and a few other funds. So there's no point. It's not going to make a big difference if you don't have the conviction to choose a index fund. How can you be? How can you be any kind of investor? Honestly, choosing an index fund is the simplest, easiest thing. You have Nifty. There are like 15 index funds and ETFs. You have to get rid of the ETFs, at least most of them, because they are not trading at high volumes, and there are price nav fluctuations. Then many of the index funds don't have a high AUM. At least 1,000 crores they should have. They don't have that. That just gives you a handful, 4 5. You must ultimately, however you do research, you can only get a short list. Finally, you have to do inky pinky ponky among your short list. If you don't have this conviction and you are always confused, well, I mean, there's no point. And people don't have unwavering faith in the indices. That's just not on. The primary reason for choosing index funds is not because they have low expenses, is not because of some theory which says the market cannot be bet, which is debatable, arguable, whatever. The primary reason for choosing an index fund should be is your realization that look, today what are supposedly top funds will not be top funds in future. In the future, some new 5 top funds will come, and I will have to switch all my units back to them if I want to stay invested in the top funds. So fund selection is always active. Fund selection is always going to be a pain in the ass, and I will have to go through periods where I'm paying high expenses and the performance is bad. Instead of all this headache, the simplest thing is choose just track the index. Anyway, if the equity is going to beat, if the market is going to beat inflation, then I will also get that inflation beating return. It does not matter whether active funds do better or less. It doesn't matter. It doesn't matter whether they have downside protection or not. I am going to manage my portfolio and make up for it. And even better, the best advantage is anybody, my spouse can manage that index fund portfolio, or if I have to bring in a fee only advisor, it's so easy for them to advise on that portfolio without making any changes. Because if you have 5 active funds and go to a fee only advisor, chances are most of them will say change these funds, because they may not like it, they will find some fault in it. But if you say I'm going to be an index investor, don't touch my index portfolio, they will have to work with that. So those should be the driving factors for you in choosing an index portfolio. That kind of maturity is pretty much absent. Yes, Ashal Johri has that maturity, therefore he is doing it. But that doesn't mean other people will be successful in it. I'm including myself. I am also not a very mature investor. The only reason I am successful is I'm extremely lazy. I will not change my funds whatever happens, other than the fact that I will invest in a disciplined manner and do little bit of portfolio management here and there. I'm extremely lazy, and that's the reason why in my opinion I have become wealthy. But that's a different matter. I'm not saying I am mature. I don't belong to that kind of that superior maturity that Ashal Johri has. That's not my point. But the point is, you have to get into a level where you say, look, it's portfolio management with active funds, reviewing the funds, worrying about whether they are worth investing or not. That problem is eliminated by index investing. Who cares whether active funds can beat the market or not? Anyway, most of them will not. I mean, at least half of them do not beat it. Not most of them, at least half of them. How can I always be in that half which is winning? So this maturity that you cannot, and you have to keep juggling among the active funds, that only people who have that maturity can become index investors. But then even among people who have that belief, conviction, maturity and so on, then they start, should I invest in this index fund or that index fund? Oh my God, stop asking questions and take some action and leave your portfolio alone after you take that action. That is the reason why I'm saying most people will be unsuccessful in index investing. They just don't have the maturity, they just don't have the conviction. It's just not the